Well, investors are certainly gearing up for what could be a weak or disappointing earnings season. Big banks kicking the earnings season off later this week. Now, the fallout from the collapse of Silicon Valley Bank has really spurred mixed narratives on the street as to where the economy is headed. But we've got someone here at the desk who says there's no question that we are headed into a recession. Julian Brigden, Macro Intelligence 2 Partners co-founder and president. Julian, it's great to have you here in studio today. But certainly, at least from that intro, it doesn't sound like you think things are going to get better anytime soon. How much worse are they going to get?
So we wrote a 3-part series for our clients at the beginning of the year. We sort of set out how we think we're going to get an inventory cycle. So we just overstocked during COVID. We're now starting to see volume of sales start to fall, even though companies are doing well disguising it because they've been increasing prices so that the revenue's there, but the volume is dropping away, which is what really counts in the economy. The second thing, we thought we were going to already see a credit crunch even before Silicon Valley Bank. And some of our leading indicators have taken quite a material downturn since then. And then the final thing is we think the employment slowdown is coming. And that's going to kick in as we move into the second half of the year. We're losing momentum in employment. And it's all about momentum in employment. It's either rising or it's falling. It very rarely sort of sits around statically for a long time.
Julian, I got to tell you, I'm seeing all the same macro headwinds, but at the same time, you look at the technicals within the stock market, it's a different picture. In fact, here's some words from one of your recent reports. At a first glance, equities appear to be in a parallel universe because we're seeing some strength. And given all the negative headwinds we've had, you might think stocks would be down 20% in March. Definitely not what happened.
Absolutely, Jared. It's very perplexing. I think it's the most complicated market to trade. I think we are still being driven by liquidity. I mean, the Fed has had to back off from their QT with these new expansions that have driven the balance sheet to be larger. I think also we're starting, I know today's a little different, but we've seen this big roll back into the sort of FANG stocks. It reminds me a little bit of the height of COVID. We had these stocks that we bought because they could kind of grow when there was no growth, right? They essentially became replacements to the bond market. And if you look at that relative price action, that's what's been driving us, outside, the last couple of days, the market in general. And there's such a big weighting in the index that they support the index. So yes, I'm sitting here going, this really shouldn't be happening. But the reality is, unfortunately, the equity market, since the Fed pumped in trillions and trillions of dollars, has become a liquidity play, not necessarily truly a macro play. We'll just expand PEs again if we have to.
So let's just talk about this potential liquidity play right now, because we are seeing ongoing QT, that's quantitative tightening. The Fed was in the middle of lowering its balance sheet or shrinking its balance sheet, had to expand that briefly. It looks like it's heading back down. But then you take the latest bank readings, bank statistics we got from the Fed last Friday. They're saying that lending is contracting by the fastest pace since the global financial crisis. So liquidity is not right there, at least in certain metrics. Wondering how you incorporate this into your general theories here.
So I think when you look at the overall economy, it's very important because that helps you select the sectors that you want to be in. When you look at the broad market, I tend to look at the liquidity metrics. So I'll weight my views in the equity market based upon those two metrics. And I would agree. I mean, the data that actually came out last week is actually lagging to a lot of our models. So our models showed big deterioration. I think the one that you've got to focus on coming up is going to be the senior bank loan index, which comes out, I think, in the first week of May. The Fed actually will be very interesting because the Fed will have that going into their meeting. So it could be a tell if they don't raise rates, because the base case is that
Nick
they do.
Timmerhouse will tell us all a week beforehand,
right,
or a day beforehand.
Absolutely, you're spot on. So I do think, we've got to watch this broad liquidity provision. I think they've probably done what they need to do for now. We're not seeing a domino sort of run on these regional banks. I do think it's going to be more of a slow bleed out and tightening of credit. And I think that will just affect broad economic activity. The overall level of the market, I think, gets set, though, by that combination of the Fed's balance sheet, the repo market, and what the Treasury does with their Treasury General Account. That's where the broad market gets set.
Well, Julian, given all of that, clearly investors, you think, should take a defensive position, I would guess, right now. I guess how defensive should that positioning be at this point?
So look, personally, I'm sitting on a decent amount of cash. I've been investing it in the sort of front to middle part of the Treasury curve. I don't want to go too far out because I have some concerns further down the line as to rates. I've been playing international. We've been looking at precious metals. They're coming up to some quite big points. If we can break above those, I think we can have a decent run. I generally think, though, as we look out 6 months, that investors have to watch the dollar very carefully, because I do feel we're at one of these inflection points where we could start to move, where this dominance of the US, where the US has been the only place to put any money for the last decade, is starting to change. And I think if you get in at ground level, there's an awful lot of money to be made in these markets.
Quick follow-up, because we got time for one more. Where would we put that money in effects? Yen, because we do see a strengthening of the yen at this term in the business cycle, but maybe you're talking about something different.
So we've been long yen. Today was a bit of a painful day after Ueda came out and said he's not doing anything and up short dollar yen. But we've actually been long yen and short the dollar against that. The one I'm watching very, very closely is the euro, and if only because it's a dominant part of all the big indexes like the DXY and the dollar index, but also because it's coming up to some very, very important levels. Sort of 109.30 level is a big level that I'm watching. I think if we can break that, we would likely, 80% of the time, you set the highs and lows of the year in the first 3 months of the year. So if we start to break above 109.30 and then above 110.30, the odds are this is a dollar down year, a euro up year. And that, I think, will set the tone for a lot of, certainly our investment thesis, if you get dollar weakness.
Julian, let's talk a little bit more just specifically about inflation, the cost pressures that we certainly have seen there. The inflation obviously remaining much higher than where the Fed would like to see it. We're getting that data point later this week. When do you expect to see substantial improvement? By that, I mean a pretty big drop with inflation. Is that something that you think we could see by year end, or are we looking out into 2024?
So I think the headline is coming down now. I think we're in the process of seeing that happen. And the market is looking for a pretty abrupt drop in headline inflation. Core, most of our work is suggesting we start to peak out in the fourth quarter and only start to aggressively drop in 2024. But once again, we're coming down. We're coming down really for the wrong reasons. Yeah, certainly. And something. Julian, I love having you on set. I'm a little worried, though, about the predictions, I gotta say. I think there are plenty of opportunities. They may not be where people have made money in the last decade.
Yeah, very important to point out. Julian Brigden, always great to speak with you. Thanks so much.
Thank you very much.